Let's get back to Eric Robertsen from Standard Chartered Bank. Eric, you are positive on emerging markets. Is India the exception?
No, not at all. Look, India has, a couple of advantages going for it. The bond's still quite attractive in yield terms. So as we were talking about earlier, the demand for carry, the demand for yield from global investors will attract capital. We have seen quite a bit of capital come into India already this year from foreign investors. We expect that to continue. One of the concerns has been inflation this year. India does stand out as having a higher inflation rate relative to its peers in the region, but we do expect that to come down in the first half of next year, and we would expect the RBI to offer a few more rate cuts. The other interesting advantage that India has is that it remains one of the larger, if not the largest, manufacturers of vaccines. So for companies like AstraZeneca, that will offer India a very interesting path out of the COVID pandemic. So I think there are a couple of positives for the country that investors are starting to appreciate.
No, I think that is definitely an issue that you hit upon, Eric, that has not really been getting any press at all. And that is the generics industry. And I'm just wondering whether India's generic sector can really be pressed into action to really scale up the distribution efforts. Is that part and parcel of the economic revival as well?
Well, look, Sri, I'm not a pharma expert, and so I take this with a grain of salt. But I do think that one of the challenges that people have voiced about the vaccine narrative for next year is things like manufacturing, distribution, transport, etc. And so I think as the markets start to understand that there are manufacturing and production facilities around the world, not just in the US, not just in the UK, I think that's going to offer people a sense of respite in terms of thinking about the distribution. And so I think for Asia specifically, having a very large pharma hub and a generics hub, as you described it, in India, I think is ultimately a very big net positive.
Okay, Eric, let me just push back on the India story just a little bit, because fundamentally the bad loans that have really characterized the crisis in the non-banking financials sectors, that hasn't gone away. In fact, it's probably just been amplified by the downturn, by the pandemic demand shock. How does India address that?
Well, look, you're absolutely right. Challenges in the onshore banking community in terms of their balance sheets and their ability to extend credit has been a known challenge for a couple of years now. Obviously has not improved yet, but we are seeing quite a bit of liquidity in the banking system. Now, part of that is through the RBI's direct measures. Part of that is a function of currency intervention, where they are buying dollars and selling Indian rupee, and that adds liquidity to the system as well. And so I think one of the things that we have seen, which will ultimately be a significant net positive, is in terms of liquidity provided to the banks, even though they have perhaps stretched or challenged balance sheets, I think is going to be more than sufficient. And so when you do see an inflection point in the growth narrative, which we do expect to see in the relatively near future, again, that liquidity offers quite a bit of fuel to that turnaround. So I think we will see a pretty good improvement in the onshore narrative over the next 3 to 6 months.
Eric, if I can just transpose some of those issues onto the Chinese market context, when you consider default risk is rising over there, but Beijing is engaged in this war of debt now, war on debt, enforcing credit discipline. Is that a net positive for Chinese assets and confidence?
Yeah, look, I think it is. And one of the things that we have written about over the last couple of years is that as China's onshore credit markets evolve, you will need to see credit pricing reflected properly in the credit curves and the yield curves. And that means that you need to see corporate names trading at different spreads to each other based on their perceived credit quality. You can't just have a very binary world of either AAA or near default. There's loads of credits that trade or should trade in between that. And so I think allowing some of these credit events to play out, allowing debt restructuring, in some cases allowing debt default, I think allows the onshore credit market to develop and to mature, quite frankly. And so we take it as a significant net positive. Now, the good news, in addition to that, is PBOC has run a very neutral monetary policy over the last couple of quarters. We've seen a big focus on fiscal, and that means that there's not a lot of excess liquidity sloshing around the system, which could go into sort of the re-levering of inefficient balance sheets. So I think we're seeing a maturing of the credit cycle and for the corporate credit market in general in China.